Welcome back, Watchman. Let's learn. Today we're going to break down smart money so we can get a better understanding of who is actually moving the markets. We're going to talk about what an institution is, the methods that you use to trade, and how we can track their movements through the filings. Alright, so, institutions. It's a legal entity that gets money from a bunch of different places, small investments, and puts it all together and trades in these giant trades that we just can't do as retail. They get, the more you buy, the less it costs. You ever hear that? And they're getting discounts on their fees for making all these giant trades. So, what makes an institution? It's going to be three things really. The scale of their operations. They have to have a minimum of $100 million in what the assets under management, AUM. And these are the guys that, if you watch price and time and sales, these are the guys trading the 10, 20, 50,000 shares every couple times a day, couple times an hour. That's not us sitting here on Reddit and YouTube trading. I mean, yeah, some of us have that many shares, of course, but most of what you see on the tape is definitely not retail. We'll break all that down later. Another thing that one of the requirements to be an institution, they're legally bound to invest in the best interest of their clients. They're regulated by the SEC. It's not. We don't have to deal with that as retail, as much. But these are the guys that move the market. They move so much money that they're the ones that are making the needle jump up and down. It's not retail dumping. Yeah, that's not good, but that's not what's making the market move. Alright, so we got 6 different types of institutions, the big 6. We got retirement funds, pension funds for employees of companies, and then you got like school institutions like Harvard, and then you have like government state-owned funds, government retirement funds, and what else was it here on the notepad? Insurance companies, big major corporate insurance companies. They're investing their premiums so they can, have more money to pay out in the future. Then you got the popular ones everybody knows about, mutual funds and ETFs and BlackRock and Vanguard. And other hedge funds that these are guys that invest on behalf of other investors, they're hedging. So it's not, they're not necessarily on our side. Alright, now we can get to the cool part. Institutional strategies. Start with the passive titan. These are the guys that are just tracking indexes. They're not researching. They don't care about the future of the company. Their DVLT shows up on a list, and these guys are like, okay, it's on this list. Let's buy it. This is popular passive strategies. This is like the SPY or the Qs. Our top holders, look, so we have 45% of all retail ownership is passive investment in DVLT. We got Vanguard, BlackRock, and Northern Trust as the top 3 I have on here. I pulled all this information from the latest 13 filings. We got I took State Street off because they dropped us from the XSD, so we lost we lost all their shares pretty much. So this is the top 3 holders from the ones I could figure based off of the 13 filings. Yeah, 45%. And then we can move down to the next Titan, the Quant Titan. These are the bots that you see on time and sales when you watch, if you watch it live all day. These are the guys that are selling 20,000 shares for a tenth of a penny 40 times a day. We got 14% of the total retail, total institutional investment is quant, which since this is a reporting from December, it's very doubtful that these still hold these shares. We got Jane Street, 4.5 million shares, probably does not have those shares right now. It could, but I doubt it. Then we got opportunist institutions. These are the guys that are buying the rumor and selling the news. They trade on events just like that, 10Ks, mergers. The Anson funds, the one that we saw, there was a recent news article about Anson funds that was way late, talking about how they bought more shares when they in fact closed their entire position. So it's no guarantee that these guys have their shares either. They only make up 1% of all of the institutional ownership, so it's not that much. Another major strategy is the growth Titan, growth at a reasonable price, GARP. These guys, they want growth and value, but they don't want to pay too much for it. I don't know how much cheaper they want this to get before they get in, but you know, doesn't seem to get hopefully much cheaper. Let's see, where are we going next? Active growth. These are the important guys. These are the ones we want to get involved. When they get involved, that's when the market sees a future. I could only find one investor on the list that employs an active growth strategy, and that's, if you look down, it's Franklin Resources. They reported holding 80,000 shares, 79,000 shares. That's a 0.2% of all institutional ownership. But then again, this is all reported from December, from Q4. You know, we have a deadline for Q1 filings is in May 15th. So we don't know for sure until we see those filings start coming out as to who's changing their position or what. And there's actually another group. I didn't make a Titan for wealth advisories, but these are like Morgan Stanley and UBS group. These just invest money for like private investors that have a bunch of money that are like, hey, here, invest my money. I want to retire off of it. Alright, so how do we figure out who's who? Well, there's actually an easy way to do that. And that's all in the filings. Okay, so let's get to the filings. 13F, everybody knows about 13F. This is the standard institutional ownership filing that we see. It's only required for people that have the 100 million in assets under management. If they don't have that much, you're not technically required to file as an institution, because you're not, I guess. but not too many people know about the 13D and the 13G. Alright, so for those of you that do, some of you don't know the difference between 13D and G. I didn't really know this until I learned it recently when I got involved with DVLT, but these are very different, very similar but very different filings. The 13D is going to be when somebody is buying more than 5% of the company and they have an active interest in trying to become involved and influence the company. Whereas the 13G is for the same size of investment, 5% or more, but they don't really, they just want to invest. They don't really have any interest in like assigning board members or anything like that. So we can use this information together with the numbers in the filings and see, try and track who's actually investing as far as institutions go. Because a lot of people are seeing, Vanguard, yeah, they increased their shares 11 million, but that's not because Vanguard's like, yeah, go DVLT. They're not. it, it's not as exciting as some people make it. I'm sorry, I'm rambling. It's late. I'm tired. That's gonna cover it. I'll see you Monday, and until the end of all things, Night Watch stands.